Welcome to Striking Options, the show that reveals the options you have to better navigate markets. I'm Jeff Kilberg, and we've adjusted our show until we can get back into the studio. I'm joined today by Bob Icino. Welcome, Bob.
Thanks for having me again, Jeff.
Well, Bob, I'm excited. Here we are in the heart of earnings season. We certainly have a couple different things to cover today, but I want to start with technology. Tech time. It's really interesting to see. This week we have the tech giants reporting. We see the Amazons, we see the Facebook, we have Google. So many of these tech giants are reporting. So what's your thought process? Are we going to be disappointed by tech, or will we see a move higher in this tech surge?
Well, I think there's likely to be a little bit of a pullback. One of the things I've been looking at is the commitment of traders. When you look at the index futures, there's very high short positions right now, and they've been declining slowly. But I still think the driver is going to be tech, and tech should lead. I think that's a good thing if it does.
Yeah, it'll be interesting. There's 140 S&P 500 companies reporting this week, but we are focused certainly on the tech sector. But how do we mitigate risk, Bob? Because I know we have E-minis, we have micro E-minis, we also have options on futures. But during times of this type of volatility, how can someone potentially mitigate risk or even gain exposure to some of these FANG stocks?
Well, with the indexes where they've been recently, Jeff, one of the things I look at is that those two things might actually be the same right now. And it's one of the beauties of the micro E-mini, NASDAQ, and S&P specifically, simply because you're probably building a core position in stocks because we've had such a sell-off that it's looked at as a discount, but you can still gain exposure to the downside without eliminating your stock position. Some people might be looking at that as a hedge. I look at it as a way to take a short position without getting rid of these core positions we've been building.
Yeah, that makes a ton of sense. And due to the fact that it has around the clock access, liquidity, and the low cost of capital to get the exposure, it makes a lot of sense to have that tool in your toolbox. But let's shift gears, Bob. I want to talk about global central bankers. It seems like they've had a kumbaya moment in the wake of the pandemic crisis. Will we see continued stimulus or additional stimulus out of these global central bankers?
I think there's no way to answer that question with a no, Jeff. They're going to
Okay.
be continuing to leave the spigots open. And over the long term, liquidity is really what's going to drive markets when you have issues like this that drove markets down in the first place.
Yeah, I think that's right. The Bank of Japan, the ECB, the PBOC, a lot of additional stimulus probably coming down lock and step to kind of shadow what the Federal Reserve has done here. But it's interesting, whenever you see central bank intervention, or at least I should say historically speaking, Bob, we do see support in the precious metals. So gold and silver, is that direction in gold and silver going to continue higher because of this central bank intervention if we lean upon history?
Yeah, historically, as you mentioned, there's a strong correlation between specifically the US Fed's balance sheet and precious metals. I would say that I would favor gold over silver at this point, but silver can get a nice bump if there's an infrastructure deal, being an industrial metal as well as a precious metal.
Oh, that's a great point, Bob. We'll definitely be looking for that. But Bob, I want to thank you as always. We want to thank you for tuning in to Striking Options. Please tune in every week as we will continue to strike options.